I would say that investors have to pay less attention to narrative and more attention to arithmetic. Invest in markets that are unpopular today that you think have to go up. Specifically, invest in commodities that are essential for the future of humankind, where the selling price of the commodity is less than the cost of production. In other words, where if the price doesn't go up, society won't have the material. You can't lose money doing this.
Hello, and welcome to the Market Bull Podcast. Please note, topics and stocks discussed in this podcast are not financial or investment advice. Rick Rule is a widely recognised investor with over 50 years of experience. He is also the president and CEO of Rule Investment Media, which helps investors build portfolios. We started the conversation by looking back at what happened in 2023 equity markets and what could potentially unfold in 2024. Rick talked about uranium, silver, oil, coal, gold, copper, nickel, and lithium, whilst also looking at different jurisdictions. He also touched on his annual event that's being hosted this year and how investors can get involved. Here is Rick Rule. So hello, I'm Ben Kostrich, and this is the Market Bull Podcast. Joining me today on the show, he joined me early last year, is Rick Rule, the president and CEO of Rule Investment Media. He's an avid investor himself, has been in it, I think, for over 50 years. I was trying to do the maths, and has been across all the booms, the busts, the cycles, and everything one could imagine. So welcome back to the show, Rick.
Pleasure, Ben. Thank you for having me back. I appreciate the opportunity.
When we last spoke, the markets were interesting. Uranium hadn't had the run. There hadn't been a few geopolitical issues and tensions as well. But looking back on, in particular, what unfolded in 2023, I just want to get your thoughts on what you saw and, I mean, some of the signals that have now sort of led into this 2024 market.
Well, I think the best educational lesson was uranium. Um, 2.5 years ago, when the uranium price was about $20 a pound and had to go up, nobody cared. Now the price of uranium is $100 a pound, maybe a little more. The price doesn't have to go up anymore, although it might, and everybody cares. One truism in investing in capital-intensive cyclical businesses like natural resources is to make a lot of money, you either have to be a contrarian or you're going to be a victim. Most people, unfortunately, require psychological gratification, which is to say that they understand the narrative that a price has to go up. But until the price goes up, they don't have the courage of their convictions. So although they understand philosophically the technique, they can't bring themselves to employ it. And people need to improve in that regard. Everybody asks me, Rick, what's hot? For me, at age 71, I'm better off investing in what's not. I don't want to compete with a bunch of young, smart, fast kids like you. I I want to get there well before you do because you don't care, because it's not sexy. That's kind of how I think veteran resource investors always behave.
Interesting. Yeah, the uranium acceleration last year, and I know we talked about, lights had to go on, and that was one of the key phrases that you sort of continued to say throughout the year. And the rise was emphatic, and now we're seeing, I guess, a bit of cooling in some areas, particularly in the ASX. And it's had investors sort of going, "Oh, I've missed out." And that's just the natural progression of smart money flowing in, making the money, and then getting out. And then looking forward into 2024, I mean, you said you're looking for the commodities that aren't as sexy and aren't as attractive for probably most investors that are on Twitter that are just seeing, uranium, just a hashtag or whatever. But looking forward now into this sort of growing 2024, we've got, the US primary elections that always creates a bit of buzz, and then into election cycle. When you're analyzing and potentially looking at investments and where to place your money, is there particular avenues that you're looking at or hypothesizing that could gain some momentum? Or again, are you just paying attention to the signals of where the money is and then getting in then?
No, I couldn't care less about signals. I look for things that are out of favor. and companies that exhibit value. In terms of out of favor, there's nothing that's quite out of favor enough, with the exception of coal. And investors who aren't invested in coal, that is to say, natural resource investors who aren't invested in coal, I don't know. They ought to think about going to work for the Postal Service or something. A little less hated, but still very, very, very cheap, would be oil and gas. I'm not an expert on the oil and gas scene in Australia, although I used to play that game 20 years ago. But certainly the North American oil companies, and for those people whose timeframes existed to 2025 from 2024, the North American natural gas industry, very, very simple and very, very cheap. These companies are making a lot of money at current prices, a lot of money. But because they're viewed as being politically incorrect, the institutional holdings of these companies are decreasing, means that the stocks are getting cheaper. Meanwhile, the companies themselves, some of them at least, are deferring sustaining capital investments, which means that oil supplies will continue to be tight because if you don't invest money, you can't produce. So names as unchallenging as ExxonMobil, the best capital deployer in the oil and gas space, maintaining, in fact, increasing sustaining capital investments with a discovery in Guyana that's large enough to move a company the size of Exxon, with a commitment to increase returns to shareholders by 14% this year. Uh, this is simple.
Mm.
If you have more guts, North American natural gas, really depressed, really hated right now. But if you look at the arithmetic, natural gas in West Texas commands about $2.25 per million BTU. That same gas landed in Tokyo or Rotterdam commands $8 or $9 a million BTU, and it takes between a buck and a buck and a half to get it there. This is a stupid arbitrage, truly a stupid
Mm.
arbitrage. And mercifully for me, nobody cares. Lovely.
Yeah.
Of things perhaps of more use to Australians, don't look for what's hot, look for what's not. Nickel. They're shutting down primary nickel production all over Australia. Australian investors are starting to believe that nickel's a four-letter word. The nickel price collapse is very easy to understand. The Indonesians permitted massive laterite nickel production in Sulawesi. By the way, I flew over those mines a couple of months ago, and they are disgusting. The environmental degradation that's taking place as a consequence of that is something that I think almost guarantees that the production increases that we've seen won't continue. And the second thing, of course, is a replay of what we saw in 1990, which is the Russians dishoarding of nickel. So happens the Russians have some use for money right now. And the consequence of that is that they're selling everything they have in the cupboard, including a lot of nickel. That selling abated last time after about 18 months. I suspect the Russians will run out of nickel. And I suspect that 2026 will be a superb year for nickel. Might be too early to get in now, but the point is, don't look for what's hot. Look for what's not.
And another,
Another
yeah.
wonderful example would be platinum and palladium for the same reasons. The Russians are selling the stuff. The Russians will run out and the prices will come back. Lithium has lost its glow, although I think the cost of capital is still too cheap for the industry. I suspect that the lithium doldrums, at least the equity doldrums around lithium, will get much more intense. But there will come a time when the big thinkers of the world suggest we won't need any more lithium. When people look at it, they say, well, the price has fallen by 50%. Yeah, after it ran up by 500%. Can I go lower? Yeah, absolutely, positively. The point of all this, though, is to focus on what's not hot, not what's hot.
Yeah, the lithium pull off, and you mentioned ExxonMobil. I know they last year were looking to get into the lithium processing capabilities, and they're a player that when they start getting in there with the cash balance that they have on hand, they're hopefully going to be able to nail it. But you don't want to sort of say that until you see it happen. But more so, you're talking about a lot of these commodities, and I wanted to get a bit of an understanding as to
from an investment point of view, are you looking at potentially companies that have got no real jurisdiction boundary? For example, you're not just looking at North America, you're looking at South America, you're looking at Australia. I mean, how do you go through looking at these and going, removing potentially some of those biases that some investors have when it comes to, oh, I don't want to invest in a company that's got a certain asset in some jurisdiction because of, potentially sovereign risk? Or on the other side, are you buying potential commodity, just the actual raw value of it, like a sprott or physical gold and stuff like that?
I try to buy the best deposits I can, irrespective of jurisdiction. I've learned after 50 years in the business that all governments are bad, all, and that the most dangerous government is the government closest to me. The biggest actual loss I ever suffered from political risk occurred in something called Viceroy Mines. We made a discovery, sadly, 7 miles on the wrong side of the California-Nevada border. So my biggest political risk loss in my life took place in California when I lived in California. So I think there are no good jurisdictions. There are some better jurisdictions, WA probably being a better jurisdiction. Chile for 40 years was a better jurisdiction, but now the voters in their wisdom have chosen to snatch defeat from the jaws of victory. I would rather take technical risk, which is to say have a deposit worth stealing than have a lousy deposit in a so-called good jurisdiction. The consequence of that is that I take political risk, and I've been punished. I I had the temerity to attempt to invest in Afghanistan about 20 years ago. Afghan American mining lost 100% of capital employed. On the other hand, I've been an extremely successful investor in Congo for 30 years. So I will take political risk rather than taking technical risk.
Yeah, because that's almost the foundation, at least from my sort of understanding of how I've been told, is people always say, "Oh, look for a safe jurisdiction," and it's that word that's thrown around that you just sort of second guess and go, What does that actually really employ, or what does that actually mean?" And I think that's one of the emerging trends at the moment was for investors that have access to, a mobile app that can invest in companies all across the world. Traditionally, 10, 15 years ago, it was a little bit harder, but now it's incredibly easy. But there's that almost bias that creeps into decision making, and people don't want to take that, I guess, decision in the end of the day, which is why I
Ben,
wanted to get your
there's not
thoughts.
an almost bias. There's an actual bias.
Mm.
I'll get some hate for saying this, but folks who look like you and me uh, believe that money stolen from us by Caucasians in English, according to the rule of law, is somehow less gone than money stolen by non-traditional means, particularly by people who don't look like us. I think people tend to accept theft if it occurs to them in ways that are normal in their own culture. So when you invest for 10 years in something and you're right, and then the government puts in place an excess profits tax and steals 75% of what you were entitled to because of your foresight and investment, that's somehow not regarded as political risk. When companies report that they paid some African politician $70,000 in a Rolodex, or in a Rolex watch, pardon me, that's a bribe. But when the same company pays $10 million in a campaign contribution in the United States, somehow that's not a bribe. People have a very odd view, in my opinion, of political risk.
Mm. Yeah, it's fast. Yeah, especially saying that now, again, it gets the sort of brain thinking going. It's amazing how, either the perspective is set and therefore, people just assume, and you say the word assume is very dangerous for many. But moving forward, I've seen a lot of activity from yourself about, and this is off topic, but the banking scene and yourself moving into this realm. And in Australia, we've got really a finite number of banks, and they're
Yep.
very well supported by the government. But in the US and other areas, the banking system is, well, it's like you said, you're entering into the market. So from yourself personally, going into and starting Battle Bank, and there's a few more steps to go through. Why have you decided to go down this path?
Well, I've been in the banking business for years. I'm known in many sectors as a natural resource investor, but I've also been investing for many years in not fintech, but in conventional financial services, banking, investment banking, asset management, multifamily office management. And I love the banking business. I laughingly describe myself as a used money salesman. And it's a very, very, very good business. You aggregate deposits for savers who don't have perhaps the time or individually the risk tolerance or the expertise to be lenders themselves. And you apply those funds for borrowers who, if you do it correctly, are involved in operations that you understand, where you have some hope of getting your money back. Uh, it is such a good business that if you don't get too aggressive, if you don't make mistakes, it's actually difficult to lose. Fortunately for me as a competitor, many of my other competitors would either be too greedy. I guess that's what you have to say. They're too greedy to play the game right. As an example, they get involved in time spreads, which is to say they buy long-term obligations or make loans with long-term obligations, and they fund that with overnight money. If the interest rate goes up, either they have a funding gap or the money leaves the depository, as it did with First Republic Bank, and they're left with a bunch of underperforming assets. That is a really, really, really simple thing not to do if you're not greedy.
Mm.
A really simple thing not to do. Another problem that you see in banking, particularly with the big banks, is their belief during periods of surplus liquidity that they're experts in all industries. You'll find a commonality in the 7 banks I've been involved in, which is to say, we were extremely good at 3 or 4 different things, and we didn't do anything else. The idea that I could compete in the communications business or in the retailing business when I don't know how to dress myself is a non-starter. But I'm a pretty good oil and gas lender. I'm a pretty good mining lender. In our new bank, we will lend to individual investors who own physical gold and silver in storage. I speak to that community. So the idea that in banking you just do things that you do well and know well, and you leave the gamier stuff to somebody else makes an awful lot of sense to me personally.
Yeah, it just feels like was it a more of a timing and opportunity sense that crept into your mind and building this? Because again, to start it, it's not really you'd say you could just anyone could go and start a venture like this. Was that part of the driving point as well? I mean,
Well,
those
what
2
was
points?
most important, in 1998, we formed a different bank called EverBank. That was a very popular US bank. It was one of the first internet banks in the US. It was started on my living room floor, actually. We grew that bank from 0 to about $28 billion in deposits. And then we sold that to a big insurance company, Teachers Investment and Annuity. They had 1.5 million of their own members. So the innovative marketing stuff that we had and the products that we had became superfluous because their market was retired teachers. Ours was entrepreneurs. We had spent 14 years developing a customer base of 275,000 customers for EverBank. And after the bank was sold, that institution left its customers. And those customers began to contact those of us who had built EverBank and saying, we feel deserted. If there's a great big market out there that needs to be served, even at age 70, I can't resist the temptation. So we reassembled the senior team that had been so successful at EverBank, and we formed a new bank, Battle Bank. You could say it was opportunistic, but it didn't have to do with the banking cycle. It had to do with an orphan community of 275,000 people who we had serviced once before, and the ability to service them with the team that had been successful servicing them once before. Now, I need to say that the current stress in the U.S. banking system is tailor-made for us. We come into a circumstance with no commercial loan portfolio. We we come into a circumstance with no pissed off depositors. The fact that our competition is hobbled by their own prior mistakes is pleasant for us. I have to admit that. But if you look at the opportunities that our competitors have missed, I'll name a couple. Most of our competitors have 10 or 15 different savings products, 3 or 4 of which don't want to pay the depositors anything for their deposits. I could understand how the depositors would rather have a deposit with us where they get paid interest on their savings. This isn't rocket science, it's just treating the customer fairly,
Hmm.
which some incumbent banks have no interest in. A second is, and we pioneered this at Everbank, in a country the size of the United States with as many first-generation immigrants as we have in the United States, the idea that you could only bank in US dollars is pretty stupid. At Everbank, we allowed people to bank in 22 different currencies. The consequence of that is that we got $8 billion in foreign currency deposits. Despite the success we had at Everbank, the new bank, Battle Bank, will probably be the only bank in the United States that allows Americans to have certificates of deposit in currencies other than US dollars. Um, the third thing, and this astonishes me, Ben, probably the same in Australia. The best collateral in the world I know is gold. And if you gold in segregated accounts where the bank actually controls the collateral, if the customer doesn't pay you off, you can sell that collateral and collect your money, remitting the overage back to the customer. You can do that in 10 seconds. Yet, with $33 billion in precious metals held in segregated accounts in the US, no bank in the United States, except for Battle Bank, that I know of, will lend money against physical gold. Now, if I were Bank of America or Wells Fargo or JP Morgan Chase, I could understand how a $33 billion market wouldn't be worth getting involved in. The lending spread on that wouldn't pay the CEO's salary, but our salaries are less. So as you can tell, I'm really looking forward to competing in that business again.
Yeah, I can sense the joy in your voice, and I saw some talks about you saying that you might be age 71, but you still got the energy of a 20-year-old, and you can just hear that. So going forward, when is that potentially really unfolding? And of course, I mean, I'm sitting in Australia, so I doubt I'll be able to really get access to it. But
It 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 took us 2 years with Everbank before we could reach accommodation with Australian and American, authorities to allow Australians to bank with us. And I would expect that it'll be 2 years before we can allow Australians to bank with us. What we did have at Everbank, even before that, is a fair number of first-generation Australian businessmen who were residents in the US, who had businesses in Australia and the US, and they could maintain banking relationships with us in both currencies. And when they went to convert Australian dollars to US dollars or US dollars back to Australian dollars, we would affect those transfers for 50 basis points, where ANZ or Commonwealth or Bank of America would charge them 200 basis points.
mm,
It wasn't a great sales job for me to explain to these first generation Australian businessmen that 50 basis points in fees was better than 200 basis points in fees. And I look forward to having that same conversation with first generation American businessmen again.
No, it's going to be an exciting year, and I'm sure it's unfolding throughout this year, with a sort of mid-year potential launch date. But you mentioned there gold, and we sort of glossed over it briefly, but more so from a commodity point of view, gold, even when we talked about it, was approaching it's been consolidating arguably for the last handful of years. But yet there's still this attraction and central banks buying some gold. I remember last year that there were some big buying. Haven't heard much more so recently, but what's your insights on, yeah, holding physical gold or potentially the producers? Where are you seeing the real value utilized, knowing that probably the small end of town has been struggling incredibly difficultly since COVID, really?
Well, there's 5 or 6 questions all wrapped up into one there,
Mm,
so I'll do my best to answer them sequentially. In the first instance, why gold? Uh, Gold, simply put, is catastrophe insurance. It is what people buy when they're afraid of the maintenance of their purchasing power in savings and investment products that are denominated in fiat currencies. It has been thus for 1,000 years, and it is so today. When will gold move? Well, my answer to that is I began enlarging my bullion holdings again in 1998. And in terms of when will gold move, 23 years ago. The price of gold then was $253 US an ounce. It's 2000 now. So over the last 23 years, gold is up a little over 8% compounded. In other words, it has stood the test of time relative to inflation. Try to find very many equity indexes, never mind bond investments, that have generated 8% compound rates of return for 23 years. I happen to believe that the gold price is going to rise faster in the future, but I don't need that to justify my narrative. Why might it be so? Well, historically, gold has done well when people are concerned about the maintenance power of their savings, particularly in the world's reserve currency, the US dollar. And why might people be concerned about that? Well, for one, quantitative easing, the tendency that the United States has to create new currency units out of thin air, unbacked by anything. Whether or not you think that's good political policy, making a whole bunch of something does not enhance the value of the existing supply of that thing. By the way, Ben, if you were to go print Ben's, your own quantitative easing, you would be called a counterfeiter and you would be put in jail.
Unless it
But
was
if
a
you were
Ben
a
coin.
congressman or a member of parliament, it would be highly popular public policy and you would be reelected. Irrespective of that, it doesn't increase one's faith in the store of value of existing currencies. But it gets much worse, of course. From a US perspective, and I'm sure from an Australian perspective too, debt and deficits at the federal government level are terrifying to anybody who can do arithmetic. In the US, I don't know your numbers, but in the US, our on balance sheet obligations exceed $34 trillion. Now, your readers' eyes will glaze over because they don't know what a trillion is. Suffice to say, it's a lot. But of course, it gets worse. The off balance sheet liabilities, not represented by bonds, but rather promises to pay, entitlements, Social Security, Medicare, Medicaid, old guys like me, military pensions. Uh, that number is estimated by the U.S. Congressional Budget Office to exceed $120 trillion. So at the federal level in the United States, the on-balance sheet liabilities, off-balance sheet liabilities exceed $150 trillion. And we propose to service that with a budget that's in deficit $2 trillion a year. In other words, we're not servicing it, we're adding to it.
Mm.
And that number came about at interest rates that are half the interest rates that exist today. Truly ugly. But the thing that should make you most afraid of savings assets denominated in the US, and I suspect the Australian dollar, is negative real interest rates. Your listeners, I think, have been conditioned by the ABC and by American networks to believe that the CPI, the Consumer Price Index, uh, is a measure of purchasing power. But it's not. It's an artificial construct. First of all, it's hedonistically adjusted, which means that the guys who create the index assign values, non-market values, to things like technology and housing. Secondly, when it's inconvenient, it doesn't include food or fuel. I happen to like to eat. So that's problematic for me. But the worst thing is it doesn't include tax, the largest component of living expense that most Australian and American families face. So a cost of living index that doesn't include tax is farcical. My own belief, Ben, and this is anecdotal, is that in terms of the basket of goods and services that I purchase, I'm hesitant to call tax a service, but we'll leave that aside, uh, that the purchasing power of my savings is declining at about 7% compounded annually. So if I put my money in a US 10-year treasury at 4%, in a currency where my purchasing power is declining at 7%, what is happening is I'm losing 3% a year compounded for 10 years. The government promises me that this is true. The first promise in my life that I believe that they will in fact keep, but not a promise that makes me feel very comfortable with maintaining savings and investment assets denominated in US dollars. So I believe I have to own gold. I also notice that nominally at least, the prices of gold and silver mining companies measured against the price of the commodities is the cheapest it's been in 50 years. If you believe, as I do, that the gold price is going to go up, at least nominally in US dollar terms, it stands to reason that the mining companies could and probably should outperform the metal. You need to be willing to do some work. You need to be able to take operational risk to make the transition from being a bullion investor to an equities investor. Mercifully for me, I enjoy doing it. It's a pleasure. It's not work. But I think that lays out the case very well. When audiences say to me, when they talk about near-term price movements in gold, my eyes glaze over. I couldn't care less. I don't own it because I think it might move from 2000 US to some technical breakout level at 2275 or some hocus pocus like that. I own gold because I'm afraid it's going to go to $8,000 or $9,000. I remember in the decade of the 1970s, the stuff went in US dollar terms from $35 an ounce to $850 an ounce. Now, admittedly, that was from a price controlled level. But in 2000 to 2010, no price controls. Price of gold moved from about 250 to about 1800. So it isn't a 10% move that interests me or a 15% move that interests me. To me, that's background noise.
Mm.
It's trading, flotsam and jetsam. I own gold because I'm afraid it's going to go to $8,000 or $10,000.
Perfectly unwrapped question you've done there. That's given you, as you said, about 6 or 7 elements to unpack, and you've gracefully dissected all of it. And this sort of leads me to, well, a big event that happens every year for yourself, which is the Rule Symposium. And I think, sadly, me being based here, it's a little bit harder for me to make the journey. And I'm sure your countless followers across the world, the ones that are in Florida, have a luxury. But talk us through a little bit about that, because you're joined and always joined with just an incredible host of guests and business professionals from all walks of life that you've interacted with. I mean, give us the rundown on what's going to be happening this year.
Well, Ben, first of all, I've removed the geography excuse for you because for the second year in a row, this will be live streamed and you can attend the conference from the comfort and convenience of your own home. So I won't allow the fact that you're an Australian resident to deprive me of the benefit of your company.
True this?
Let's talk about why you might attend. First of all, this conference is, I think, the finest retail natural resource conference on the planet. It's been in existence for 22 years, which means in addition to being the finest, it is far and away the oldest, like its host, me. The unique features. The first is for 28 years, whether or not you attend in person or online, there is a gold-plated money-back guarantee. If for any reason we don't exceed your invitation, your expectation, email me and I'll refund you your tuition. Nobody else has that kind of confidence. I need to say, in 28 years, we probably haven't had to refund 0.5% of the tuitions that we've charged. But the fact is, we're confident enough that we add value that there's an absolute, no questions asked, gold-plated money-back guarantee. I'll try not to repeat that more than 10 times. Why can we do this? Well, first of all, we assemble a great, great, great group of global macro thinkers, but not the kind that you would see on the ABC. The Jim Rickards of the world, the Doug Caseys of the world, the Bill Bonners of the world, the Daniela DiMartino Booths of the world. If we're lucky, maybe the Ian Plimner from Australia, Ian Plimners of the world. There's a whole group of people that have been quietly right for 20 years while mainstream media has been quietly wrong. And we bring them to our audience. Once the audience has been exposed to a different way of thinking about global macro, we introduce them to some of the best analysts and editors in the world, uh, experts at constructing real natural resource portfolios. And when I say experts, I don't mean brokerage industry geeks who, flunked out of, flunked out of pot stocks and flunked out of tech stocks and flunked out of motion picture stocks or something like that. I mean people who've been making money constructing natural resource portfolios for 30 years. We move on from them to my favorite feature called the Living Legends. Every year we have 4 or 5 people speaking at the conference who have built multi-billion-dollar natural resource companies from scratch. And they could talk to you about the process by which they built it and the lessons that they learned that make them and can make you a better investor. This is where the rubber meets the road. These are not guys using other people's money. These are people who've used their own money and built multi-billion-dollar companies from scratch. Hugely, hugely useful. The fourth factor, unlike any other investment conference on the planet that I know of, is every exhibitor at the conference has to be owned in my portfolio or in a portfolio that I advise. Now, unfortunately, Ben, the fact that I buy a stock doesn't mean that it goes up.
Mm.
What it does mean is that I know the company well enough that I've invested my time and treasure. For most conferences, the qualification to be an exhibitor is a check that cashes. That's it. It's
Yep.
totally advertising, but not at my conference. So the value proposition is this. First of all, as I say, money back guarantee. Second of all, come to Boca Raton live. Don't just hear the speeches. Rub shoulders with the speakers. Go on the boat cruise in the Intercoastal Continental Canal with a beverage of your choice, and visit with the speakers and other attendees. Or if you can't do that, which I understand, join what was last year 1,100 other attendees on the live stream. Whichever way you come, in person or on the live stream, you will have access to the conference recordings for the balance of the year, because I guarantee that in 4 days, 48 hours, we will give you more information than you can absorb at one setting. It will be important in terms of you getting out of the conference everything that you can, that you replay those recordings several times. I put on the 2023 conference, pardon me, and I still had to play the tapes 3 times.
Well, I'm glad you threw my because excuse to the wind with the virtual, and I recall you mentioning that last year, but it's from the 7th to the 11th of July, and I'm sure that the speaker panel is going to grow. I know you've got your website, which we'll have in the show links, but in a takeaway from the discussion that we've had today, and more so, I'm liking to summarize, the key takeaway points so that people can, everyone loves it in threes, can think about what might unfold over the coming year or potentially our conversation today. I mean, summarizing that, what would you say are the 3 key takeaways from our discussion?
I would say that investors have to pay less attention to narrative and more attention to arithmetic. Invest in markets that are unpopular today that you think have to go up. Specifically, invest in commodities that are essential for the future of humankind, where the selling price of the commodity is less than the cost of production. In other words, where if the price doesn't go up, society won't have the material. You can't lose money doing this. Understand that your time preference is irrelevant. Many people have trauma holding stock over a long weekend. But money is made via compounding. So you need to think in 4 or 5 year terms, not 4 or 5 week terms. And I think it's very important, too, that you be tenacious. When I think of the big wins that I've enjoyed in the equities markets over 50 years, I mean the big wins, the speculative wins, What I find is that my average holding period is 5 or 6 years, and the average stock at some point in time during those 5 or 6 years exposes me to a 50% price decline. In other words, I had to have enough courage of my convictions that I view a price decline as being positive so I can buy more, as opposed to being evidence of some form of guilt or fault. I think those are important. So for investors making things easy, it's difficult for me to understand somebody with any means at all who doesn't own a little gold as insurance. It just makes no sense to me. I think for investors, you need to be in the conventional energy game. By the way, I'm not saying not to be in alternative energies. I'm not. What I will point out, though, is that we've spent now $5 trillion on alternative energy generation in 40 years, and we've lowered the market share of fossil fuels from a high of 82% all the way down to 81. Fossil fuels are much bigger businesses, and they're going to be with us for a very long time. And investors who aren't in that space are silly. I mean,
Mm.
they're just silly. So I hope those are I guess I gave you 4 takeaways, and you asked me for
That's
3, but
that is completely fine. I think
great.
everyone will appreciate those words of wisdom from yourself, and you always come with just a wealth of knowledge and just a way of speaking, which I think employs people to really pay attention. But yeah, I appreciate this conversation, Rick. It's always fun for myself personally, and I know there's countless others that would love to have these conversations with you. So that's another sort of invitation to go to the event and meet you face to face. But thank you so much for taking the time to speak with me on the show today.
Always a pleasure. One more time, you can attend virtually, and there's a gold-plated money-back guarantee.
Thanks for listening to the Market Bull podcast. If you enjoyed it, please make sure to like and subscribe. You can follow the Market Bull on our socials at Twitter and LinkedIn by searching The Market Bull. You can also subscribe to our newsletter on the website by visiting www.themarketbull.com.au.